Small can be beautiful in a world where the supersizing trend is impossible to miss. The same applies within an investment context. Big isn't always better. I went to speak to two experienced investors who believe the future is small. With more than 30 years investment experience, Gervais Williams is a well-known investor in smaller companies.
Hello, Maike.
How are you doing?
Nice to see you.
You too.
I think the meeting's with you. I think the thing about smallness is it's about biodiversity. The mainstream markets are dominated by large companies, which in themselves have been successful over many years, but have a pattern of performance which is different from smallness. And so it's about diversification, moving away from just relying on largeness into an area where perhaps small companies which can buck the economic trend, companies which can grow when the world's not growing, some of them, not all of them, and most particularly companies which are perhaps exposed to some of the newer trends coming through, some of the niche companies coming through.
How small is small?
Really good question, because what's small to some people may be big to someone else. It's not a clear definition. If you look at some of the largest companies in the US, they are very substantial, but what they call small companies would be quite big companies compared to many of the companies that are quoted in the UK. So the UK has a heritage of smallness. It has a heritage of quoted companies being very small, and it's that ability to invest in very small at a time when it's not very accessible around the world that really drives our growth.
Next, I went to speak to Mark Slater of Slater Investments.
If you get a small cap right, your chances of making a multiple of your money are good. With a large company, it's much more difficult. For a Unilever to double, and it's a great business, it's very difficult. They've got to create tens of billions of value, which is not easy. But when you get it right, you can make a lot of money.
One of the key risks, which is always mentioned when you talk about small company investing, is liquidity.
Sure.
How do you manage that risk?
Well, it's difficult. I think liquidity is very unpredictable. There are some companies that are nominally quite liquid, and you go to buy them and you can't buy any, or you can't sell any. And there are some companies which you expect to be very difficult to buy, where you can buy loads. But what we want is, in any fund we manage, we want the aggregate liquidity to be acceptable. I would say in general, the key thing with liquidity is if you're taking liquidity risk, you've got to be paid for it.
Like his late father, renowned small companies investor Jim Slater, Mark holds firm to the belief that elephants don't gallop.
I think where small companies are attractive, particularly in a world where there's a lack of demand, is there's always something good going on. There are always a number of niches that are attractive. And in general, I would say that large companies tend to be less niche. At any time, even in the worst points of 2008, 2009, there were interesting areas of the economy that were doing very, very well. So small companies can give you that exposure.
It's tough to grow when the world's not growing. It's tough for big companies, it's tough for small companies. But you do find some small companies with a local client base, they're not so dependent on the growth in China. They're not so affected by the unsettled nature of the Middle East. They have a local presence, they have a local customer base. They can invest for productivity improvements because they're investing on a small scale basis at a time perhaps when big companies are struggling. So smallness is about moving beyond the credit boom and growing at a time when perhaps markets are more difficult.
Big companies are often favoured because they pay dividends, but you see an income story within the smaller company space.
Really, we're interested in companies which can generate a yield in time, but most particularly how much they can grow that dividend yield. Now, if you go back to the 70s and the 60s and the 50s, when the world was unsettled, when the UK had a stop-go economy, when we had problems with the exchange rate and interest rate rises and deflation in the 60s, small companies, through agility, through being able to invest at a time when others couldn't, actually delivered more dividend growth. So we think, although you might not always get such a good yield at entry, there'll be more dividend growth.
Because it's easier to grow a business from a low base, smaller companies offer the greatest potential for future earnings growth. And that, after all, is the real driver of long-term returns.